So I want to get more now on this from Julian Callow of Barclays Capital. He's been an economist now for 24 years, also a member of the shadow ECB since its formation a decade ago. Good to see you, Julian. Thanks for joining us.
Good calculation, sir, yes.
Yeah. So, now, you're saying it's a positive thing. We got a relatively early agreement. It came about in a timely manner, and will both the government and the opposition manage to agree on something?
Well, I think that's the critical thing. We mustn't forget that this has been undertaken in the face of an election campaign, and that does set things back to some degree. And so whereas ordinarily a package might have been agreed within 2 weeks, this one has taken about 3 weeks. But nonetheless, we have a deal. It's quite a large amount, this 78 billion euro figure. It's considerably above what we would estimate that the strict needs of the government for financing would be. And that's an interesting issue. I think perhaps that there were three reasons for that. First of all, this probably does include something for the Portuguese banks. We estimate ourselves maybe 7 or 8 billion euros would be needed for the Portuguese banking sector. Secondly, there have been a few suggestions that the implicit assumptions for real GDP for Portugal might be as bad as -2% growth in real GDP both for this year and again for next year, which would certainly be a very negative scenario. But if that's true, it would suggest that the authorities are taking an important lesson out of what's happened for Greece, which is if you do embark upon very large fiscal consolidation, and indeed in the case of Portugal, the previous government's plans were to achieve fiscal consolidation around 5% of GDP this year, well, then there is going to be quite a big hit on real GDP, particularly on domestic demand. And so that could explain those rather negative GDP assumptions if those are verified. And thirdly, then there's likely to be a big cash buffer in place just to allow for some unforeseen overshoots. Because, of course, one of the problems in the Greek package is that the plan was that there would be a return to market financing later in 2012.
Julian, you mentioned the Portuguese banks there. Does this mean that, I mean, is this a good thing that money is being set aside for them? Does it mean that they'll lessen their dependency on ECB funding?
Yes, I mean, I think clearly the European Central Bank is going to be very keen to get a more normal state of affairs with respect to the financing it's providing the banking sector, and the Portuguese banking sector, along with that of Ireland and Greece, have been the big consumers, really, of ECB financing. And therefore, this should, I think, in the context of the latest upcoming round of stress tests, enable there to be quite a significant moderation in terms of the demand from the ECB, and I suspect quite a large proportion of the financing over and above the actual pure strict needs of the government, which are probably more like 60 billion euros over 3 years, will be there to really once again supercapitalise the banking sector and therefore help it to stand alone in the financial markets.
Julian, how difficult, of course, you know, nothing comes without conditions. How difficult is it going to be to implement structural reforms while bringing down the budget deficit?
Well, Portugal has really quite low labour costs. If you look at the US government international comparisons, they're only around $12 an hour, which is comparable to those that you see in Central Europe. But the big problem is the geographical position of Portugal, and it doesn't really have such good transport links to the rest of Europe. So really, Germany as an economy is on fire right now. It's really extraordinary just how much tightness we're seeing in parts of the German labour market, in manufacturing, how upbeat business confidence is in Germany. It's not really matched elsewhere, particularly among the other major countries in the euro area. But what it means is that countries that are neighbouring Germany are really benefiting from that. And that's particularly true for Central Europe, which is a source of cheap labour and receiving a lot of German investment. And meanwhile, Portugal, which had been able, when it entered monetary union, to compete on the basis that it's got low labour costs, is increasingly marginalised here as industrial activity increasingly concentrates close to Germany itself. And so the Portuguese government, the institutions, they have to figure out a new growth model for Portugal, because Portugal's had woeful levels of business investment in the last 10 years. And consequently, it's had woeful productivity growth. And that's reflected in very weak real GDP expansion. And whatever interest interest rate is going to be given to Portugal, it's undoubtedly going to be a lot higher than income growth in the economy, and so it's going to have a big penalty.
Competitiveness is a big problem, isn't it, for many of these weaker Eurozone economies, Julian? And just a quick one, want to put that comment to you, David Blanchflower, hearing a clip from him before saying, listen, you're not going to resolve this by piling expensive debt, more expensive debt on these countries. What do you think about that?
Well, to be honest, it does add to the burden a lot, the more expensive debt you're delivering. And I think that the best hope for the countries is to reduce their deficits very quickly. And Portugal has still a very large underlying deficit, and that should really be the key challenge. This is really what Iceland was doing, and Iceland got over things quickly. It's what the Baltic states do. Even though it's very tough to recommend it, it seems that the quicker you can overcome that adjustment process, then you find your new base, and then you can grow from that. And the longer you try to taper things out, then the more you're piling up the debt without a very satisfactory growth model.
There you go, Julian Callow of Barcap. Thank you so much.